Welcome, deep divers. Get ready, because today we are diving headfirst into the world of numbers, the kind that tell powerful stories, reveal hidden truths, and honestly make you feel instantly more informed. This is your shortcut to understanding the pulse of a business or really any data set without drowning in the raw figures.
That's right. Today we're going to, pull back the curtain on how organizations truly operate. We'll start by mastering the fundamental language of business performance,
Oh,
financial statement analysis.
okay.
Then we'll expand our view to the expansive, really game-changing world of data analytics. It's all about transforming what often looks like, well, an intimidating pile of raw numbers into crystal clear understanding and genuinely actionable knowledge.
And our mission for you, our dedicated listener, is to go far beyond just defining terms or, reciting formulas. We want to help you truly grasp what these tools mean, why they matter so profoundly, and how they can reveal the true underlying story of a business, an industry, or frankly, any complex information you encounter. It's about empowering you to spot the patterns and, well, the power plays. Okay, let's unpack this then. When you look at a company's financial statements, like its balance sheet or income statement, you're essentially looking at the raw ingredients, right? It's all the data, but it hasn't been cooked or seasoned yet. So how do we begin to make sense of this financial recipe?
That's precisely where financial ratios become our sharpest tools. Think of them as incredibly intelligent financial indicators. They distill complex information by quantifying the relationship between different items on those financial statements.
Yeah.
So instead of just seeing a large sales number and a large profit number, you see how much profit is generated per dollar of sales. The real power of ratios, however, is in comparative analysis. You can track a company's ratios over different periods to spot crucial trends.
Ah, so like year over year changes.
Exactly. Or compare them against competitors and industry averages. This helps everyone from investors to lenders identify where a company truly stands, whether it's, gaining strength or facing headwinds.
So why should you, the listener, care about these seemingly complex calculations? I mean, what's the practical payoff for understanding them?
The payoff is immense. These ratios give you immediate X-ray vision, allowing you to quickly pinpoint a company's underlying financial strengths or weaknesses that raw numbers simply don't reveal.
Right, instead of digging through pages and pages.
Precisely. You get a concise snapshot. Broadly, these key financial measures fall into four high-level categories: profitability, liquidity, solvency, and performance metrics. Each category offers a specific lens to evaluate an entity's health and performance trends. And here's a quick tip, a pass key, if you will, for understanding how ratios behave.
Yeah.
If the number in the top part of the formula, the numerator, goes up, the ratio usually goes up. Simple enough.
Okay.
If the number in the bottom part, the denominator, goes up, the ratio generally goes down. It's an inverse relationship.
Got it.
Now, sometimes a change can affect both parts, and it's not immediately obvious what happens. In those tricky situations, honestly, the simplest way to figure it out is to just quickly plug in some made-up numbers into the formula and see the result.
Huh, really? Just make up number.
Yeah, it's a surprisingly effective practical trick. It cuts through the complexity.
All right, here's where it gets really interesting, I think. Let's dive into that first category. Profitability. This is the big question everyone wants answered, right? Is the company actually making money? How do we tell if a company is truly successful at turning its efforts into profit?
Absolutely. Profitability ratios are exactly that. They measure the success or, well, failure of a business over a specific time period. They reveal how efficiently a company converts its sales into actual profit. Let's start with two core ones. The gross profit margin. This tells us how much profit a company makes from its sales after accounting for the direct costs of producing its goods or services.
The cost of actually making the thing they sell.
Exactly. For Geog Company, in year two, their gross profit margin was 44.44%. So for every dollar of sales, about 44 cents was left after covering production costs. A higher margin here means they're very efficient at managing their core operations and keeping production costs down.
Makes sense.
Then there's the net profit margin, which takes things a step further. It reveals how much profit is left after all expenses, operating costs, interest, taxes have been paid.
The bottom line. Fix that.
For G Company, their net profit margin in year two was 11.11%. A higher net profit margin is always desirable because it shows genuine overall efficiency. This number is critical for a company's future. It impacts decisions about how they fund their growth and can even influence stock performance.
Okay, what else falls under profitability?
Another important one is return on sales. That's income before income, interest expense, and taxes divided by net sales. For G Company, year 2 was 17.39%.
Got it.
And then return on assets, or ROA. This ratio answers, how efficiently is the company using all its assets, buildings, cash, everything to generate profits? G Company's ROA in year 2 was 7.19%.
So for every dollar of stuff they own, they made about 7 cents in profit.
Essentially, yes. A higher ROA generally implies the company is a profit-generating powerhouse with its existing resources. It's really relevant for future projections, too.
Okay.
And for a more nuanced look at ROA, we have the DuPont return on assets. This actually breaks ROA down into 2 key drivers, the company's profit margin and its asset turnover.
Ah, splitting it apart.
Exactly. For G Company in year 2, this combination was 11.1%. Their profit margin multiplied by 0.65 times their asset turnover, which equaled 7.22%. This is powerful because it lets you see why their ROA is what it is. Is it because they have high margins, or are they just really efficient at using their assets to make sales? Or both?
That's clever. Separates the different levers they can pull.
Precisely. Finally, for profitability, let's look at return on equity, or ROE. This is a favorite for investors because it shows how much profit a company generates for each dollar of shareholders' equity.
Money invested by the owners.
Correct. Gein Company's ROE in year 2 was 14.18%. A higher ROE is a strong signal of greater profitability for the company's owners, which often leads to higher earnings per share and likely future stock growth. It's a key measure of how effectively management is using the capital invested by shareholders. We usually use average equity here to smooth things out.
Okay, one more in this group.
Yes, the operating cash flow ratio. This is cash flow from operations divided by current liabilities. For G Company, it was 0.40 in year 2, up slightly from 0.38. A higher ratio means more cash is generated from core activities to cover those current debts. Positive, sustainable cash flow is, well, crucial for ongoing success.
That gives us a really solid understanding of profitability. Now let's pivot to something equally critical. A company's immediate financial health, what we call its liquidity. Can they pay their bills right now in the short term? How do we assess that urgent ability?
Liquidity ratios are exactly for that. They're measures of a firm's ability to cover its immediate maturing obligations. They tell you how easily a company can convert its assets into cash to pay its short-term debts.
Right. Can they make payroll next week?
Kind of, yeah. The most common is the current ratio. It's simply current assets divided by current liabilities. For G Company, their current ratio in year 2 was 1.03, and in year 1, it was 1.09.
So slightly down. Is that good or bad?
Well, if you compare that to an industry average of, say, 1.50, you can immediately see G Company's ability to meet short-term obligations is on the lower side. Generally, a higher ratio is better, suggesting more readily available assets to cover immediate debts. A low or declining current ratio can be a red flag.
Okay, so 1.03 means they basically have just enough current assets to cover current debts. Not much wiggle room.
Exactly. A more stringent measure is the quick ratio, sometimes called the acid test ratio. This is similar to the current ratio, but excludes inventory from current assets.
Because inventory might not sell quickly.
Precisely. It might not be quickly convertible to cash. For G Company in year 2, their quick ratio was 0.61. Again, compared to an industry average of maybe 0.80, G's ratio suggests they might struggle to meet very immediate needs with their most liquid assets, cash, marketable securities, receivables.
So even tighter than the current ratio suggested.
Yes. It emphasizes the importance of truly liquid assets versus things like inventory or prepaid expenses.
What about how fast money comes in and goes out?
Good question. We look at how efficiently a company manages its inflows and outflows related to daily operations. Accounts receivable turnover tells you how many times a company collects its money from customers who bought on credit during a period.
How quickly they get paid.
Right. For G Company in year 2, it was 5.22 times. This gives us a quick gauge of their collection efficiency.
And you can turn that into days, right?
Yes. Hand in hand with that is day sales in accounts receivable. This gives you the average number of days it takes for a company to collect payment after a credit sale. For G Company in year 2, it was 60.83 days.
So roughly 2 months on average to get paid after making a sale on credit.
Correct. Both of these accounts receivable ratios are crucial indicators of how effective a company's credit policy and collection efforts truly are. A shorter collection period is generally better.
What about inventory? How fast does that move?
We measure that too. Inventory turnover is cost of goods sold divided by average inventory. For G Company, year 2 was 3.54 times. It measures how quickly inventory is sold. Generally, higher is better. meaning less cash tied up in stock.
And in days.
Days in inventory. Ending inventory divided by cost of goods sold per day. For GE Company, year 2 was 105.85 days. That's the average number of days it takes to sell their inventory.
Wow, over 100 days. Seems like a while.
It can depend heavily on the industry, but yes, these inventory ratios tell you a lot about inventory management effectiveness. You don't want inventory sitting around too long.
Okay, we've covered collecting money and selling inventory. What about paying their bills?
Ah, yes. Accounts payable turnover. Cost of goods sold divided by average accounts payable. G Company's year 2 was 7.27 times. It shows how many times they pay their suppliers. A low turnover might mean they're delaying payments, possibly due to cash shortages.
Or maybe they just have good payment terms.
Could be. That's why we also look at days of payables outstanding. Ending accounts payable divided by cost of goods sold per day. For G Company, year 2 was 54.75 days. The average time their payables are outstanding before they pay their suppliers.
So they take about 55 days to pay their bills, while it takes them about 61 days to collect from customers.
You're connecting the dots. And that leads perfectly into the cash conversion cycle. This is a powerful, integrated metric. It's days sales and accounts receivable plus days in inventory minus days of payables outstanding.
Okay, walk me through that for G Company.
Sure. For G Company in year 2, it was 60.83 days, AR, plus 105.85 days. Inventory, 54.75 days. AP equal 111.93 days.
So almost 112 days from when they pay cash for inventory until they get cash back from selling it.
Exactly. It's the average length of time their cash is tied up in the operating cycle. The goal for any company is to minimize this cycle. Ideally, you want to collect cash from customers quickly, fewer days in AR, sell your inventory fast, fewer days in inventory, and strategically delay paying your own suppliers, more days of payables outstanding, to conserve your cash.
It's a balancing act.
It really is. A shorter cycle generally indicates better working capital management. And just a quick reminder, many turnover ratios often use average balances for their balance sheet components, like average inventory or average receivables. But always read the question or the footnotes carefully in any real-world scenario, as sometimes year-end balances are specified instead.
Got it. Always check the details. Okay, that was a brilliant breakdown of liquidity. Now let's look beyond the immediate financial picture and consider a company's long-term viability. How secure is the company for long-term creditors and investors? This is where understanding solvency becomes paramount.
Exactly. Solvency ratios measure the long-term security or protection a company offers to its long-term creditors and investors. They assess a company's ability to meet its long-term financial obligations, its ability to stay in business over the long haul.
So less about next week's payroll, more about paying off bonds years from now.
Precisely. A key one is the debt-to-equity ratio. This compares how much capital a company raises through debt versus through equity. Total liabilities divided by total equity. For G Company in year 2, it was 0.91, down from 1.04 in year 1.
Lower is better here, right? Less risky.
Generally, yes. A lower ratio suggests lower financial risk because the company isn't relying as heavily on borrowed money to fund its operations. It gives you a clear sense of their financial leverage. Sometimes you'll see variations, like just using long-term debt instead of total liabilities.
Okay, what else for solvency?
The total debt ratio, that's total liabilities divided by total assets. For G Company, year 2 was 47.78%. This indicates their long-term debt-paying ability by showing what percentage of their assets are financed by debt.
So almost half of G's assets are funded by creditors.
That's right. Again, a lower ratio generally means greater solvency, more protection for creditors. You might also see variations here to refine the analysis.
Any others in this group?
Yes, the equity multiplier. Total assets divided by total equity. G Companies was 1.91 in year 2, down from 2.04. It's another way to look at leverage. A higher multiplier means the firm is using more debt relative to equity to finance its assets.
So related to the debt-to-equity ratio.
Very related, just looking at it from a different angle. And one more crucial one, times interest earned. This tells you how many times a company's operating income can cover its interest expenses. It's income before interest expense and taxes divided by interest expense.
How easily can they afford their interest payments?
Exactly. For G Company in year 2, this was a robust 31.3-year times. This ratio reflects the company's strong ability to comfortably cover its interest charges from its earnings, which is a very good sign for any creditor lending them money. A higher number is definitely better here.
Fantastic. We've covered the core aspects of financial health, profitability, liquidity, solvency. But beyond the balance sheet and income statement, what other specific performance indicators are crucial for investors? We're talking about how the market actually views the company, perhaps.
Precisely. These are what we call performance metrics, and they evaluate operating performance, often with a direct link to how a company's stock is performing and its investment appeal. They bridge the gap between internal operations and external market perception.
Okay, like what?
Well, a big one nowadays is EBITDA earnings, before interest, taxes, depreciation, and amortization. It's a measure of operating performance. You can calculate it top-down, starting from sales, or bottom-up, starting from net income. For Jai Company, year 2 EBITDA was $343,030. Gives a sense of cash earnings potential before financing and accounting decisions.
Right, strips out a lot of non-cash stuff in financing.
Exactly. Then let's look at earnings per share, or EPS. This is one of the most widely watched metrics by investors because it tells you how much profit a company makes for each share of its stock. It's income available to common shareholders divided by the weighted average common shares outstanding.
So profit per owner's share.
Basically, yes. For Jai Company in year 2, their EPS was $2 per share. It's a direct measure of profitability allocated to each share.
And that leads to the PE ratio.
It does. Building on that, we have the price-to-earnings ratio, or PE ratio. This takes the market price per share and divides it by the basic earnings per share. For G Company in year 2, their PE was 6.
What does a PE of 6 mean?
It means investors are currently willing to pay $6 for every $1 of the company's current earnings. This ratio is a key indicator of how investors perceive a company's investment potential and future growth prospects. Generally, a rising PE suggests investors are optimistic and are willing to pay more for each dollar of its earnings. It varies hugely by industry, though.
Okay, what about dividends?
Good point. The dividend payout ratio. This can be cash dividends divided by net income, or dividends per share divided by earnings per share. For G Company, year 2 was 40%. It shows the portion of current earnings that the company paid out to shareholders as dividends.
So G paid out 40% of its profit as dividends and kept 60% to reinvest.
That's the idea. It tells you about their dividend policy. And finally, let's revisit asset turnover. We mentioned it with DuPont, but it's a key performance metric on its own. Net sales divided by average total assets. For G Company, year 2 was 0.65 times.
How efficiently they use assets to make sales.
Exactly. A high ratio here indicates that the company is very efficient at generating sales from its existing asset base, which is always a positive sign for operational efficiency.
Okay, so after that really comprehensive deep dive into financial ratios, profitability, liquidity, solvency, performance, what does this all mean for us? Are ratios the ultimate authority in financial analysis? Can we just crunch these numbers and get a complete, infallible picture?
That's a crucial question, and the answer is no, not entirely. While ratios are, easy to compute and provide incredible insights, they do have limitations. They depend entirely on the reliability of the underlying data.
Garbage in, garbage out.
Exactly. And that data can sometimes involve estimates, like bad debt reserves, or use historical costs for assets that might not reflect current market realities, or different companies might use slightly different accounting methods. So you always need additional context and information when you're truly analyzing a company.
So what else do analysts use?
Well, to get that context, analysts often use horizontal analysis. That's where you look at the dollar and percentage change of financial statement items over time, comparing this year to last year, for instance. It's incredibly useful for spotting trends and identifying significant shifts.
Seeing what's growing or shrinking?
Right. And they also use vertical analysis. This re-expresses all items on a financial statement as a percentage of a base figure, for example, all income statement items as a percentage of total sales, or all balance sheet items as a percentage of total assets.
Ah, like we did with the profit margins earlier.
Precisely. This common-size format helps you compare a company's performance year over year, controlling for overall size changes. And crucially, it allows for much easier comparison between different companies, even if one is much larger than the other, because everything is presented proportionally. It levels the playing field for comparison.
That's a fantastic segue. We've just seen how specific financial numbers can tell a detailed story about a company. But now let's transition from that specific world of financial ratios to the broader, much more expansive universe of data analytics. This is where modern business insights truly blossom, spanning far beyond just financial numbers.
Indeed. Data analytics is fundamentally the process of taking raw data, identifying meaningful trends within it, and then transforming that knowledge into actionable insights that can help solve complex business problems.
So finding the story in any data, not just financial statements.
Exactly. The applications here range from incredibly simple calculations like sums and averages to highly advanced functions such as statistical modeling and even machine learning, where algorithms can learn and adapt on their own. Once data is properly extracted, transformed, and loaded, which we'll talk about data analytics, becomes an indispensable tool for everything from validating information and strategic planning to gaining deep insights, mitigating risks, and providing essential support for critical decision-making.
Okay, let's unpack this data concept itself. We talk about data, but what kinds of data are out there and why does its format matter so much for analysis? Is all data created equal?
That's a fundamental starting point. And no, it's definitely not all created equal in terms of how easy it is to analyze. Data generally falls into two main types: unstructured and structured.
Okay. Unstructured.
Unstructured data is essentially any data that isn't organized in a predefined way. It's often in its raw, original format, and it's not easily searchable or consistent in type. Think of examples like the vast amounts of text in social media posts.
Tweets, Facebook comments.
Right. Or the content of interview transcripts, sensor data from IoT devices, Internet of Things, or even non-traditional data types like videos and images. This kind of data is much more challenging to analyze and often requires specialized techniques like natural language processing for text.
Makes sense. It's messy.
It can be. On the other hand, structured data is highly organized. It has consistent data types and formats, making it incredibly easy to search, sort, and query. This is the kind of data you find in spreadsheets, tables, and databases.
Like the financial data we were just talking about.
Exactly. In relational databases, structured data is organized into records, essentially rows in a table where each record has various attributes or characteristics, which are the columns. This organization is what makes it so powerful for analysis, often queried using language like SQL, which stands for Structured Query Language.
Okay, so structured data has tables, columns, rows. Can you break that down a bit?
Sure. To really grasp structured data, it helps to understand its components. At the core, you have tables, which are like individual spreadsheets within a database, storing information in columns and rows about a specific type of thing, like customers or products.
Got it.
The columns are your attributes. They represent characteristics like a customer's name, address, or maybe their account balance.
Okay, the categories of information.
Right. Each record is a row in the table. It holds all the information about a single entity, say, all the details for one specific customer or one specific product.
One complete entry.
Exactly. And a field is simply where an individual piece of data goes at the intersection of a specific column, attribute, and a specific row, record, like the box where you type the customer's zip code.
Okay, that makes sense. But how do you link these tables together if you have a customer table and an order table?
Great question. That's where database keys come in. They are crucial for uniquely identifying records or linking tables. A primary key is the unique identifier for each record within a single table. Think of a unique customer number or an employee ID. Every record in that table must have a unique primary key value.
So no two customers can have the same customer number.
Correct. Then you have a foreign key. This is an attribute in one table that refers back to a primary key in another table, creating a link or relationship between them. For example, a customer ID in a sales order table would be a foreign key. It doesn't hold the customer's name or address, it just holds the unique ID that connects that order back to the correct customer record in the separate customer table.
Ah, so that's how you connect orders to customers without repeating all the customer info on every order.
Precisely. It avoids massive data redundancy. And sometimes, if a single attribute isn't enough to uniquely identify a record, you use a composite key. This is just a combination of multiple attributes used together to create a unique key. For instance, in a table listing items on sales orders, you might need to combine the sales order ID and the inventory ID to uniquely identify each line item, because the same product could be on multiple orders, and the same order could have multiple products.
Okay, that key system sounds really important for keeping things organized.
It's fundamental.
And here's where it gets really interesting, I think. All that talk about keys and tables brings us to a crucial concept in database design called normalization. It might sound technical, but you mentioned it's really about making data much more efficient and useful.
It absolutely is. Normalization is a technique that specifically reduces data redundancy. It's a formal process for organizing the attributes and tables of a relational database to minimize that repetition of information.
How does it do that?
It does this by taking large, sometimes unwieldy tables that might have repeating groups of information, and dividing them into smaller, more manageable, logically related tables. These smaller tables are then linked together by those foreign keys we just discussed. It's all about making your data set incredibly organized, much easier to maintain, and much less prone to errors when you update information because you only have to update it in one place.
Okay, can you give an example? That sounds a bit abstract.
Sure, let me give you a concrete example that really brings this to life. Imagine a college scholarship board trying to track their recruits' academic choices after they've been admitted. Let's say they have 10 recruits they're tracking, and each recruit signs up for 3 courses during their first semester.
Okay, 10 students, 3 courses each.
Right. Now, if they tried to keep all this information in one huge spreadsheet, they'd end up with 30 rows or records. 10 students times 3 courses each. The problem: each recruit's personal details, like their name, address, and high school, would be repeated 3 times in that spreadsheet, once for each course they signed up for.
Ah, I see. So John Doe's address listed 3 times. That's inefficient.
Exactly. That's a lot of duplicated, inefficient data. If John Doe moves, you have to remember to update his address in 3 different places, and you risk making a mistake. So to fix this, a relational database using normalization would restructure this data into 3 separate, much more efficient tables.
Okay, what would those tables be?
First, you'd have a recruit roster table. This would contain only 10 unique recruit records, one for each student. It would hold their name, address, high school, and crucially, each student would have a unique student ID acting as its primary key.
Got it. Just the student info, once per student.
Right. Second, you'd have a course table. This would list all the available courses the college offers, like Intro to Econ, Calculus I, etc. Each course would have a unique course ID as its primary key.
Okay, a list of courses.
And finally, the magic happens in the third table, the enrollment summary table. This table acts as the link. It would simply pair the student ID and the course ID. It might have 30 rows, but each row would just contain 2 pieces of information: a student ID and a course ID, showing which student enrolled in which course.
Ah, so it just connects the student to the course using their IDs.
Exactly. The student ID and course ID in this enrollment table are foreign keys. They don't repeat the student's name or the course title. They just point back to the primary keys in the main recruit and course tables. This whole process of breaking down that initial 30-record spreadsheet with all the repetition into these 3 smaller linked tables, eliminating all that data duplication, is normalization. It makes the data much cleaner, faster, less error-prone, and ultimately more powerful for analysis.
That makes perfect sense. You store the core info once and just link to it. Much smarter. So, okay, we have all this data. Maybe it's structured now, maybe even normalized. Is it instantly ready for analysis, or is there a crucial step missing before we can start drawing conclusions?
That's an excellent question, and the answer is almost always no. It's not instantly ready. Data must be transformed before it can be effectively analyzed. Think of it as prepping your ingredients before you cook.
Okay, why? What does transformation involve?
The whole point of this transformation is to ensure the data is complete, clean, current, secure, if needed, and ultimately in a format that's user-friendly for the analysis tools you plan to use.
So, several checks and steps.
Yes. This process involves several critical elements. First, ensuring completeness and integrity. Whenever data is moved, maybe from one system to another, or from an external source, there's a risk of loss or manipulation. It's vital to confirm that the data set is whole and hasn't been accidentally corrupted or intentionally tampered with.
Verifying you got everything, and it's correct.
Right. Second, data integration. Especially if you're bringing in external data sources like maybe real-time foreign exchange rates or competitor pricing feeds, you need to set up your systems so that this data flows smoothly and accurately into your target databases, joining it correctly with your internal data.
Getting different sources to play nicely together.
Exactly. Third, and perhaps most hands-on, is cleaning or scrubbing data. After validating its completeness, you need to assess its quality and clean it up. This often involves 4 key steps. 1, removing unnecessary things like report headings or subtotals that might have come over with the data but would just clutter your analysis.
Getting rid of junk.
2, cleaning up inconsistencies like leading zeros, extra spaces, or non-printable characters to ensure values are uniform, making sure numbers are numbers and text is text.
Standardizing.
3, formatting negative numbers consistently. Sometimes they show up with a minus sign, sometimes in parentheses you need to pick one format.
Okay.
And 4, identifying and correcting inconsistencies in text fields. This is a big one. For example, making sure that CA, Cal, and CA for California are all standardized to a single value like CA. If you don't do this, your analysis tool won't be able to accurately group or filter data by state. It'll treat Cal and CA as different places.
Oh, that's a really important detail. Got to make sure California is always California.
Precisely. And the fourth element of transformation is often data encryption. Given the sensitivity of much business data, encryption is generally required for sensitive information, both when it's being moved between systems in transit and when it's stored at rest. This is fundamental for maintaining data integrity and security.
Makes sense. Protect the data. So once the data is finally prepped, cleaned, integrated, and maybe encrypted, how do we actually extract the insights? How do we see the patterns and stories hidden within the numbers? It can still be overwhelming.
This is where the true power of data analytics shines. And you're right, it hinges on how well insights can be gained. Raw tables of numbers aren't very intuitive. That's why data visualizations are absolutely integral to this.
Charts and graphs.
Exactly. They take complex activities or high-volume content and transform them into easy-to-read graphs, charts, maps, or other visuals. This allows analysts, managers, anyone really, to quickly grasp relationships, spot trends, identify outliers, and ultimately answer critical business questions like, what's driving customer attrition? Or why did our sales forecasts miss the mark last quarter?
Seeing is believing, or at least understanding.
It helps tremendously. But when creating these visualizations, it's important to consider some key factors to ensure they are accurate, ethical, and effective, not misleading.
Oh, like what?
First, choose the right type of visualization. A pie chart is great for showing parts of a whole, but terrible for showing trends over time. A line chart is good for trends, a scatter plot for relationships between two variables. Each has its purpose. Using the wrong type can obscure the insight or even mislead.
Right tool for the job.
Second, apply correct scaling. This is a common pitfall. Typically, the vertical axis, the axis on bar charts or line charts, should start at 0. If you truncate the axis, small differences can look dramatically large and exaggerate the finding.
I've seen charts like that makes tiny changes look huge.
It's a classic way to mislead, intentionally or not. Third, utilize appropriate colors. Colors aren't just decorative, they convey meaning. Red often signals negative, green positive. You need to use colors thoughtfully and consistently, considering your audience and cultural context. Don't make it look like a rainbow threw up on the page.
Keep it clean and meaningful.
And fourth, emphasize focus areas. The design should guide the viewer's eye to the key message or objective of the visualization. Avoid clutter, unnecessary labels, or anything that might distract or introduce bias. Keep it focused.
So thoughtful design is key to good visualization.
Absolutely. Then, once you have these well-designed visuals, interpreting the results involves combining the numeric statistical output, if you have it, with what you're seeing in the visualization. This combination can produce truly actionable insight.
Can you walk through some examples, like specific techniques and how they look?
Sure. Let's take regression analysis. This technique helps explain relationships between variables like how does advertising spending relate to sales? Visually, this typically uses scatter plots with data points showing each observation and often a regression line drawn through them to show the trend or relationship.
Seeing if the dots line up?
Kind of. For example, a sales manager might use regression and a scatter plot to see if there's a positive relationship, showing that as the number of customizations a customer requested in the past goes up, their tendency to place additional orders also goes up. The line helps visualize that strength.
Okay, what else?
Next, variance analysis. An analyst uses this all the time to compare forecasted or budgeted values against actual results. How do we do versus plan? A bullet chart is often really helpful here. It looks a bit like a thermometer or progress bar, showing the actual value against shaded bands or lines designating the budget or target ranges.
So you can instantly see if you're over or under budget.
Exactly. For instance, if a bullet chart shows that both the cost of goods sold and selling expenses have significantly exceeded their forecast bars, it immediately flags those areas for deeper investigation into why.
Got it. What about comparing time periods?
We also have period-over-period analysis. This simply compares values across different time periods month over month, year over year. A bar or column chart is very effective for this. Imagine a chart showing net income by quarter, with blue bars for year 1 and orange bars for year 2 side by side for each quarter. Any significant differences in bar height would immediately call for further analysis.
Easy comparison.
Then there's classification. This is actually a predictive algorithm. It uses historical data to learn patterns and then fix new data points into predefined categories. Think spam filters, classifying emails as spam or not spam.
Or product recommendations.
Yes, exactly. Classifying you based on your past purchases to recommend new items you might like. You can visualize the results with scatter plots showing how groups cluster, or sometimes with pie charts or tree maps showing the distribution across categories, like a pie chart showing sales by state.
Okay. And trends.
Finally, trend analysis. This is used to develop expectations of future results by examining historical data patterns over time. Line charts are the classic visual for demonstrating trends because they effectively show progression and change over continuous periods.
Seeing if things are going up or down.
Right. For example, you might use a line chart to see the overall net income trend for the past 5 years. This also allows you to do things like compare the trend lines of different sales channels during a promotion to see which responded better, or observe seasonality patterns in sales throughout the year.
That's a fantastic overview of how we visualize and interpret data. So, pulling back a bit, what does this all mean for how businesses actually operate and make decisions every day? How do these powerful analytical approaches play out in the real world? Where does the rubber meet the road?
Excellent question. Data analytics has really evolved into 4 key types, each building on the last, moving from looking backward to looking forward. They generally increase in value and complexity as you move through them.
Okay, 4 types. What's the first?
The first type is descriptive analytics. This is the most basic and common. It simply means describing or explaining what has occurred. It summarizes past activity using historical data. Techniques include looking at summary statistics, mean median, mode, min, max, or sorting and filtering data to reveal basic patterns.
Like calculating average sales last quarter.
Exactly. Or, for instance, an accountant budgeting for doubtful accounts money they don't expect to collect would start with descriptive analytics. They'd research basic aging statistics of outstanding accounts receivable and look at the average percentages of past bad debts. They are just asking, what happened?
Okay, that's step 1. What's next?
Next is diagnostic analytics. This goes a step further. It focuses on diagnosing or explaining why it occurred. It attempts to uncover correlations, patterns, and relationships to explain why an event or result happened. Why did sales dip last month?
Finding the root cause.
Trying to, yes. Techniques include drill-down analysis, clicking into summary numbers to see the underlying detail, or cluster analysis to group similar occurrences, or correlation analysis between different variables. For example, if management sees accounts payable suddenly spike, they might perform a diagnostic analysis.
Digging deeper than just knowing the number went up.
Right. Maybe they perform a correlation analysis and find that the suppliers who are repeatedly making late payments also happen to have high short-term debt and decreasing operating cash flows according to public data. That diagnoses the potential why. Those suppliers likely have cash flow problems, and that's causing the payment delays. So diagnostic asks, why did it happen?
Okay, descriptive is what, diagnostic is why. What's third?
The third type is predictive analytics. Now we're looking forward. This is about predicting what will occur based on historical data and statistical models. It transforms insight into foresight.
Forecasting the future.
Essentially, yes. Common techniques include regression analysis, which we mentioned, used here to forecast future values. Also, classification analysis, which predicts which category something will fall into. Decision trees are another tool, a great example.
Yeah.
An electric power company might use regression analysis on 20 years of historical data. They might discover a strong relationship between average fall temperatures and the number of equipment failures leading to winter outages. They then use predictive analytics. Based on this fall's temperatures, they can forecast the likely number and location of winter outages, helping them preposition repair crews. They're asking, what will happen?
That's powerful, being able to anticipate problems.
It's immensely powerful. Finally, most advanced is prescriptive analytics. This type prescribes what could or should occur. It takes the probabilities and forecasts learned from predictive analytics and turns them into concrete recommendations and optimal paths to take, aiming for the best possible outcomes given the constraints.
So not just predicting, but telling you what to do about it.
Exactly. It's about optimizing decisions. Techniques here often involve artificial intelligence and machine learning, or complex scenario modeling, also known as what-if analysis. For example, a large corporation wanting to expand internationally might use a sophisticated what-if scenario model.
How would that work?
They could project various potential tax outcomes based on historical tax policy shifts in different countries, predicted economic conditions, and their own financial forecasts. Then, Prescriptive analytics could recommend which combination of international locations and operational structures would likely result in the highest profits while minimizing their global tax implications.
Hmm.
It answers the question, what should we do about it? Or, how can we make the best outcome happen?
Wow. From just describing the past to actively shaping the future, that's quite a spectrum.
It really is. And businesses are increasingly trying to move up that spectrum from descriptive towards prescriptive to gain competitive advantage.
It's incredible to see that progression.
Yeah.
So, stepping back one last time, how do these powerful data analytics capabilities, all four types, truly transform different areas of business, from sales to operations to even compliance? Where are we seeing the impact?
They permeate almost every function, fundamentally changing how decisions are made and how efficiently businesses operate. In customer and marketing analytics, for example, organizations build detailed consumer profiles, analyze spending preferences and online behavior to optimize marketing strategies, personalize offers, and ultimately increase sales and improve customer loyalty and experiences.
Tailoring things to the individual.
Very much so. For managerial and operational analytics, data is often used in real time, sometimes from sensors on machinery, to maximize efficiencies in production or logistics. This involves monitoring costs closely, tracking key performance indicators or KPIs, and using analytics dashboards to make immediate operational decisions to improve throughput or reduce waste.
Fine-tuning the engine while it's running.
Good analogy. In risk and compliance analytics, organizations can continuously monitor their financial transactions, employee activities, or system logs to ensure all activities meet compliance objectives, like adherence to internal controls, industry regulations, or anti-fraud policies. It moves beyond spot checks to continuous monitoring,
Catching problems earlier.
hopefully preventing them altogether. Financial analytics, of course, allows organizations and external analysts to continuously monitor financial performance through data mining of large data sets, and, as we discussed extensively earlier, through sophisticated ratio analysis, often visualized in dashboards.
Bringing us back to where we started.
In a way, yes, but often supercharged with broader data sets now. For audit analytics, data is key for external and internal auditors. It helps them assess risk more accurately, provide assurance around certain operations by testing entire populations of transactions rather than just small samples, establish thresholds for exceptions, and generally improve the overall quality and efficiency of the audit.
Making audits more effective.
Definitely. And finally, tax analytics is used increasingly by government tax authorities, large organizations, and tax professionals to organize complex tax information from multiple sources, improve tax planning strategies by modeling different scenarios, and continuously monitor various tax performance indicators to ensure compliance and optimize tax positions.
So, really, data analytics is touching pretty much every corner of a modern business.
Absolutely. It's becoming less of a specialized function and more of a core capability needed across the board.
Wow. We've just taken an incredible journey, haven't we? From breaking down the very specific performance of a company with financial ratios, liquidity, solvency, profitability, all the way to leveraging these advanced data analytics techniques to tell complex stories, diagnose problems, predict the future, and even prescribe actions. It's truly about making sense of the numbers that surround us in every aspect of business.
Exactly. And the power of these tools, both the traditional ratios and the newer analytics techniques, cannot be overstated.
Yeah.
They aren't just for the finance geeks or the data scientists working in a back room.
Mm.
Understanding these concepts is becoming absolutely essential for anyone looking to make truly informed decisions and to deeply understand the world around them, whether that's evaluating a business you might invest in, managing your own department's budget, or even just making sense of economic news. It's all about turning that raw information into valuable, actionable insights.
That's a perfect wrap up. So, as you, our listener, go about your week, here's a thought. How might you start applying the lens of financial ratios or data analytics to something in your own life or work? Maybe it's looking at your personal budget, not just as numbers, but in terms of ratios like your savings rate. Maybe it's tracking data on a project timeline to predict potential delays. Or maybe it's even just trying to understand a complex news report that's full of statistics by asking, what story are these numbers really telling? Remember, the numbers are always telling a story. How can you start listening more closely? Keep diving deep, keep asking questions, and we'll be here to guide you next time.